Hello and welcome guys. Today we're going to talk about the top 7 tips for beginners when it comes to investing. So let's start. First point and probably most important point of this whole video is to build an emergency fund. Why is it so important? It's because you don't want to be taking money out of your portfolio to pay for your expenses. It is not an ATM, it is a investment account that will pay for your expenses later down the road. 20, 30, 40 years from now, you will be able to pay for your expenses with your invested money. So think of it as money that has been lost. You just invest, forget about it. You never want to take out money from your portfolio. So in order to be able to do that, you need an emergency fund, a cushion built with cash that is somewhere else rather than your portfolio, and you can use that for expenses that you haven't predicted, such as your car breaking down, an unfortunate accident, something like that. So first of all, you need to calculate your expenses. Obviously, a person that has a wife, couple of kids, and a house mortgage is going to have many more expenses, and therefore the emergency fund needs to be much bigger than for a person that is a student living with the parents and only paying like £200 to £300 a month for whatever they want, right? So you want to reduce the most unneeded monthly expenses. Let's say you're paying for Netflix subscription £10 a month, but you only use it once every 6 months when your favorite show comes out, something like that. So try to look for expenses that you are paying for without even thinking about it, and reduce them if you don't use them often enough. Then you want to start building an emergency fund that will last you 3 to 6 months, because within that time frame you can rebuild the money that you have spent for the unpredicted expenses that you need to incur, right? You don't want to be taking money out of your portfolio to pay for a missed, let's say, mortgage payment or car payment, whatever it might be. So just sit down for a couple of minutes and think of all the things that could go wrong, like your car breaking down. I don't know, you need to change your tires in your car because you popped both of them, something like that. Just try to predict scenarios that you would need extra money for within a couple of months, and then build an emergency fund based on those expenses that could come across, right? If you don't have a car and you just live in with your parents, as I have said, then your emergency fund does not need to be that big, and you can invest that money into stocks that have a little bit more potential and are a bit more risky, but later, more about that later on. Secondly, you need to create a strategy that will suit you. First of all, you need to think about all of the income that you have monthly right now. So if you only have your job, then just think about how much you're getting and then divide it into percentages of how much you need to spend on crucial expenses. That is your mortgage, your rent, your car insurance, whatever it might be, food. Everyone's gonna have different expenses based on the situation they are living in currently. Secondly, you want to think of how much you can spend on investing without having to take that money out. If that's 10% of your income, if that's 25% of your income, you need to think about it, how much you can spend on your investing. Obviously, some percentage of that income is going to go into an emergency fund, as we have spoken already, but I'm just assuming that you have already built an emergency fund and you can now freely spend your money into investing, and then you can spend the rest, like remaining 10 to 20% based on your income, into luxuries. So I don't know, new shoes, new bag, whatever it might be that you fancy. Just think of investing coming first and then luxuries after, if you want to build a successful portfolio that is going to take advantage of compounding interest with dividend. But just remember, every person is going to be different. Some people, they can afford to invest 30% monthly. Some people can only afford to invest 5 to 10%, right? So just don't Google a percentages, given percentage by someone on YouTube or Instagram, and they're going to tell you 50% for your expenses, 25% investing, and the rest you can spend on whatever you like. Just sit down and think about the expenses you have and how much you can realistically afford to invest every single month. Now that we have the basics out of the way, you know how to build an emergency fund, you know how much you want to invest. You want to find a tax advantaged account. In the US, the two most popular that I know of, Roth IRA and 401k. And then in the UK, Stocks and Shares ISA. I know a little bit more about the UK one than the US. I just put it in there as an example. But when it comes to the Stocks and Shares ISA, you can put £20,000 every single year into this account. And the benefit of putting money into this account is that you will not have to pay any capital gain tax or any dividend income tax. So this is pretty much the best account that you can have when it comes to investing. So just take your time, do your research, and find an account that will work for you based on the country that you're currently living in and where you want to open your account, and just find the best one that suits and that fits your needs. Now that you have an account that will somewhat benefit you and you want to purchase your first stock, make sure to do your own research. Although it's much easier to just go on YouTube and type in top 10 stocks for this month or top 10 stocks for this year. I'll just look at Instagram and someone post, look, I'm buying this stock, and give a couple of reasons why. But always do your own research and understand the fundamentals of the business that you want to buy. Easiest way to do it is look at websites such as SIG Alpha or Yahoo Finances and look at the businesses. Have they been increasing the dividends? Look at the liabilities, look at the assets, the debts that they have. Can they pay them off with the current assets that they have? Check the PE ratio. If you look at Tesla right now, they have an incredibly high PE ratio. They are not making anywhere near enough money for the price that you have to pay for one share of the stock. So just look at stuff like that and try to do your best to understand the stock that you want to buy and whether it is a good decision. Also, look at the dividend yield. If it's too high, it might be a trap. If it's too low, might be a good growth stock. But don't base your decision only on one input, such as dividend yield or the price itself. Just do your own research, spend some time. It's your money that you're investing. Hopefully it's going to pay you back in the future. So it is pretty important to do a bit of research and understand what you are actually buying. Another important point for beginning investors is understanding ETFs. This is pretty crucial for new people, as ETFs are pretty much the simplest way to diversify your portfolio. Let's say you're buying S&P 500, which is probably the most popular stock right now. Well, always has been. Fortune 500 companies, the top 500 companies in the US, and let's say you are buying one share of S&P 500. If you do that, you have exposure to the best companies in the US, such as Amazon, Tesla, Microsoft, Google. All of those companies are within S&P 500 ETF. You are buying one share of S&P 500 and you get a piece of every single company that they are tracking. It's a very easy way to diversify your portfolio, but you need to understand which ETFs you want to buy. S&P 500 you can pretty much buy blindly every single week, month or year. If you just look at the graph of S&P 500, it has been steadily growing since 1980s. For the last 40 years, it has been averaging about 8 to 10% return on every single year. So you can pretty much buy it blindly. You can see here the coronavirus dip. It has dipped from 3.2k to about $2,000 a share, but it has rebounded and it's now standing at about 4.2k. So S&P 500 is the easiest way to invest your money while diversifying your portfolio. Investing money into ETFs is also a very good alternative for people that don't have the time to do their analysis on different stocks. Let's say you are sitting on a bunch of cash, but you are working over 200 hours a month and you just simply don't have the time to do the fundamental research for every single stock that you want to buy. You can just dump your money into S&P 500 and you should be good to go. An ETF is usually very stable and there is limited movement, as I have previously mentioned. S&P 500 usually returns around 8% annual return on average over the last 40 or 50 years. So it's not like you're gonna put your money into S&P 500 and the next day it's gonna go down by 80% like it can do in cryptocurrencies. This is a very different type of investment that is less risky and can be very useful for people that are just starting their investing journey. One of the last points we have, do not buy solely based off of the dividend yield. High yields can look very attractive for people, but they can be a dividend trap, right? So if you look at a company that has about 12% dividend yield, you might look at it and say, well, if I invest $1,000 at the end of the year, they're gonna give me back 120. But the stock price over this year can go down 20%, and then you will be left in the negative. So just going back to the doing your research, just make sure you understand why the company has such high dividend yields, because some companies have to have higher dividend yields, such as REITs, which I have made a video about. They have to dispose some of the income monthly as dividend, because that's the tax bracket that they are in. So just understand the stock and don't buy solely off of dividend yield. I have made that mistake with AT&T. I looked at the company, I saw 7% dividend yield. I was like, yep, I'm buying that one, and I've just dumped 20% of my portfolio into AT&T, which in retrospect is not a good decision. I was up a couple percent, but since they have announced that they are cutting the dividend yield by 40%, the stock has went down pretty massively. So it's just not a good decision to buy a stock based off of dividend yield alone. And finally, you want to diversify your portfolio. There's different types of the diversification. You can diversify the sectors, such as finance, telecom, health, property. You can buy into different sectors. Let's say you buy AT&T, which is in the telecom section, then you want to buy JP Morgan, which is a bank, in the finance section. That way you can diversify the sectors, and the more understanding that you have, the less you're going to diversify, because you understand the company that you're buying. But to begin, it is very much advised to diversify your portfolio. You can also diversify the companies within the sector. Let's say you buy some shares of Coke, some shares of Pepsi, and that way you are diversifying your portfolio. It's very useful to diversify in the beginning, because your research might not be as accurate. Therefore, you want to diversify and hedge your bets for different companies. If you look at an example such as S&P 500, they have companies that are up by 80-90% within the year, but they also have companies that are down 70 or 60%, but they still manage to come out in the profit for the year, because they have companies that are performing better. Like the top 10, top 15 companies are making up for the losses that the last 100 or 200 companies are bringing into the ETF. So it's just a good idea to diversify your portfolio rather than dumping all of your money into one stock or one share. But to do that, you need to understand why you're buying the different shares of different stocks, and in order to do that, you need to do some research. So it's all about research and finding out why you want to buy a certain stock. That is it for this video. If you guys enjoyed it, make sure to leave a like, subscribe to the channel. If you want to open your account with free trade and get a free share, there is a link down in the description. If you deposit £10, you get a free share of up to £200. But that is it, and I will see you in the next.